What happened to the U.S. labor market during the COVID era? Hopefully, our chief equity strategist and economist, John Blank, has that answer. John, you say this can be answered definitively now, and it starts with retirees, correct?
That is absolutely correct. It turns out 100% of the story in the COVID pandemic was retirees that bunched up. That's it. I mean, it's literally how simple it was.
Well, the entire civilian labor force participation was impacted. What's the rest of the story?
Well, one thing that was different in this COVID pandemic was women left the labor force before men because of the shutdown of schools and people needing to stay home with their children. But they came back in equal measure, and now it's the same. So that's really the rest of the story. The other thing that was endemic to it was a movement away from bigger cities to remote working and also to Florida.
Yeah, you wrote that geography does play a part in all of this, just basically what you mentioned.
Yeah, that's it. I think Florida has the lowest unemployment rate amongst the major, comparables like Texas, California, and New York, and that's 2.5%. The national unemployment rate is 3.5%. So Florida has an entire percent less unemployment rate right now.
So how does this compare with prior downturns in the labor market?
It's much lower because you have less people working or looking for work, so you have more labor, less labor supply, more labor demand, so you have rising wages and lower unemployment rates.
And why is this significant to the economy?
Because, Terry, everybody is fixated on the Fed and the rise in interest rates last year, and they're not paying attention to the few notable things, one of which is the labor market is fundamentally different now. It's fundamentally tighter. The other is we've had 10 years of zero rates. So changing the finance rates on the fly after 10 years of zero rates is 10 and a half years of zero rates and then high rates, not just suddenly high rates.
When do you see a rise back to pre-COVID levels, or are we there already?
I think we're past pre-COVID levels in consumption, and we're just about there with GDP. In a lot of countries, we're past it. I think the United States might be getting close. We'll see.
So does all of this foretell a U.S. recession? And if so, would COVID be the culprit in a recession?
That verdict is not in yet, Terry. Everybody's all but certain there's going to be a recession, but every recession tell I see is for a very shallow one. It basically amounts to no difference between a soft landing and the recession calls right now. The real issue here is if all of this goes haywire in multiple ways and causes a deep downturn in output that nobody sees. These recession calls right now, whether we get one or not, is basically irrelevant. It's all soft landing stuff.
And against this background, what are you looking for in the U.S. and global economies as we start this new year?
I'm actually, more bullish, and I've been bullish. And today we got the Q4 GDP, which was 2.9%, Terry, for Q4. And I think, 2% trend growth in 2013 might be the surprise here. And I know most calls are for 1%. Same is true outside the United States. Europe has actually got a pretty warm winter, and energy's not been as big an issue. And China is getting out of COVID. So, the actual backdrop is materially improved, and I think we'll wait to see on the numbers, but I would bet on it being improved.
You have 3 European names on your stock radar. They include Novo Nordisk, SAP, and Stellantis.
Yeah, let's do Novo Nordisk, ticker NVO first. Zacks rank number 2, A for growth. It's definitely priced in. Forward P is 33.5, but that's a PEG ratio of 1.8. You got to like a stock like this in Europe, particularly with the turn in the currencies. SAP, ticker SAP, this is the number 2 ranked stock. F for growth, though. But again, forward P at 21, PEG ratio of 1. This is actually overall a better price stock. And if you like tech stocks, you got to like SAP. And Stellantis, ticker STLA. From a style scores perspective, long term, this is the best of the bunch. A for value, A for growth, A for momentum, $15 a share. It's the only auto stock in our entire system, Terry. That's a 1 rank, or was a 1 rank. It's 3 now, but it was a 1 rank. It's the only one that's getting a bid right now.
Our chief equity strategist and economist, John Blank, with his assessment of the post-COVID labor market. With John, I'm Terry Ruffalo. Here's something you might want to check out. Just released 5 stocks set to double where Zacks experts announce their single favorite pick with the potential to gain 100% and more in the months ahead. And download the private special report that names these stocks and spotlights why their upside is so exceptional when you go to Zacks.com/promo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.